Hi everyone, my name is Teh Kapo. I will be the moderator for this event. Thank you all in the first place for coming to join us on this webinar. This afternoon, we have a panel of 4 very distinguished speakers to come and address the subject of how COVID is affecting international real estate markets. Let me introduce to you each of these speakers. We have, first of all, Mr. Andy Lee. You will see their photos and their names here on this slide that you are looking at on the screen. Andy has been involved in real estate investment management for the last 27 years. He has done deal sourcing, structuring, execution, asset and development management, as well as divestment. He's currently the Chief Asset Management Officer with Pontiac Land, which is, I'm sure you're familiar with them. They are a very large real estate developer with a portfolio of high-end luxury properties across many markets in New York, Sydney, Singapore, and the Maldives. Prior to Pontiac, Andy was the Senior Vice President of GIC Real Estate. And in his 19 years at GIC, he has been involved in investment and asset management activities in a host of countries, including Japan, Russia, China, India, Europe, and Southeast Asia. He was also stationed in GIC's London office from 2003 to 2005. And before that, he was with Keppel Land. He graduated from NUS in 1993 with a BSc in Estate Management, First Class Honours. Right, so that's Andy. Dr. Chua Yang Liang is currently the Head of Group Research and Strategy at ARA Asset Management. There he's responsible for monitoring, evaluating, and forecasting the macroeconomic environment, as well as major real estate markets globally. And through his analysis of the micro and macro market trends, he provides research, advice, and market intelligence to support ARA Group's business decision-making and strategy formulation. Prior to ARA, he was with JLL for over 10 years, leading the Southeast Asia research teams. And he began his career in fiscal and strategic planning at URA in Singapore. He holds a Bachelor of Science Estate Management First Class Honours from NUS and a Master of City Planning, plus a doctorate from the University of Pennsylvania in USA. He's also an adjunct researcher with the Center for Livable Cities, Ministry of National Development. We have Terence Tang. He is a highly tenured leader in advisory services and principal real estate investment management. And his deep expertise is founded on more than 31 years of successful acquisitions and investments across Asia. He has worked in both the private and government sectors, and he has led more than 150 real estate transactions worth a total of US $10 billion. Today, he's the MD of Asia Capital Markets and Investment Services at Colliers International, where he leads a team of more than 130 senior executives across Asia. And before Colliers, he had senior roles with GIC, Invesco Real Estate, AIG, and Jones Lang LaSalle. And during his time at GIC, he spearheaded the acquisition of a mixed-use commercial complex in Shinagawa, Tokyo, worth $500 million US. He also pioneered several crucial market investments first, including Invesco's first investment in China worth US $200 million and securing AIG China's first investment in the commercial development site since the 1980s. And last but not least, we have Mr. William Tan. William joined Keppel Land Group in 2001 and was appointed as Head of Property Development Operations, as well as Head of Smart Development in 1st January 2019. And prior to his current appointment, he held various senior management positions in Keppel Land China. He was a regional head responsible for Keppel Land's business in North China, and also served as chief rep of the Keppel Corporation, not just Keppel Land, but Keppel Corporation, the parent company in China from 2003 to 2009. He started his career in his real estate career in China since 1994, so he's a real China veteran. And prior to joining Keppel Land, he was with the renowned real estate company in Singapore, responsible for marketing, investment and business operations of all the projects in Suzhou, Shanghai, and Beijing. And in his current role, Mr. Tan oversees all property development operations for Keppel Land in China. He is also the head of smart development, driving the use of smart technologies and data analytics for generating a new engine of growth on top of property development. William is a Singapore Chinese Chamber of Commerce and Industry scholar and holds a BSc Estate Management Second Class Upper from NUS, and he's also a qualified real estate appraiser. So I'm going to hand the time over to our speakers. First of all, Andy, for him to share his thoughts on the impact of COVID-19 on the international real estate markets. And so, Andy?
Thank you, Kapo. Okay. Well, I think all of us know that the impact of COVID-19 is far and wide-ranging. I mean, to me, this is one of the worst crises I've experienced over my 27 years working experience, where I suddenly see that working from home for the last, 3 months, I couldn't imagine my whole company, working from home. Actually, if you tell me 6 months ago, whether can we have, half the company working from home, I probably say no, but today we know it's possible. So there is a lot of impact. And I think the immediate impact we have seen, especially is regards to the hospitality and retail sector. We have, for example, hotels were doing more than 80% occupancies pre-COVID, and suddenly overnight we are on single-digit occupancies. With the border closures, with the lockdown, it just kills all the business immediately. So the impact is really, really huge. I mean, less impact would be things like office sector for now, but as you all know, office demand is driven by GDP, and with Singapore GDP in the negative and global GDP is likely to be negative, we foresee that the demand for office space will be affected going forward. And not only in terms of demand due to the business sentiment and GDP, but also like working from home. As more people see that they can work from home, companies might reduce their demand for office space in terms of some people might be able to work from home, or they might have spoke and approach some of the company staff could be in decentralized location rather than everybody in central location. But at the same time, whether will demand as a whole go down is still to be debated, because there will be issues like social distancing, physical distancing, where it require maybe the density to be reduced per worker. Previously, like maybe 10 square meter per person, now might be increased. So it's yet to be, the story is yet to be known, okay? Lesser impact currently what I see is a residential market, but as more and more people are not able to fly in, because most of our residential, let's say for the higher end, where you rely a lot on expatriates. So if they cannot view, they cannot come in, then eventually there might be an impact on the residential market as well. But the point to note, and importantly, is that yes, crisis is bringing a lot of issue, but I always believe that we should never waste a crisis. Okay, never waste a crisis, because with crisis there's come opportunity, whether it's in the investment front or asset management front. Okay, for investment front, importantly is first you make sure that you have a strong balance sheet first before you start going to to look for distressed acquisition. I mean, previously from where I came from with GIC, the best time for it is always during the crisis, whether it's the Asian financial crisis, the global financial crisis, SARS, is when everybody is, where credit is tight, when distress is there, where you have the money, that's where the opportunity is, and where you make super normal profits. In normal situation, typically you get your normal profits. So take the opportunity if you have a good and strong balance sheet. One thing I learned about with regards to this COVID-19 is, we tend to look at previously country diversification as important, but COVID, unlike many other crises, is global. It's not just restricted to a certain region or certain country. So diversification by sector probably is also to be considered going forward. On the asset management side, I always see that when market is down, when activity is slow, for example, whether it's your hotel or retail, it's time for you to do your asset enhancement. So if you have a strong balance sheet, good cash flow, let's try to do all your asset enhancement during this period where the opportunity cost, for loss of income during this period is the lowest. So prepare your asset for the future. So the other thing is also try to improve all your processes. With COVID-19, where everybody is working from home, we realize digitalization is important. Centralizing all your knowledge management is important, so that you can able to extract information or retrieve all your data anywhere, anytime. And I know a lot of companies are not ready for that. So they're forced into trying to immediately, digitalize all these things. And I think it's a good thing to do it so that going forward, they are more ready. And maybe before I pass to the next speaker, one last thing I would say that it's very important that for us to look into the staff and tenant safety, measures, because it's very important during this period. The staff itself feels whether are they safe to go back to the office, or the tenants. So communication is very important. Communicate to them what have we done for the building, in preparation for them to come back to the office. While they are away, do we flush the water, service the aircon, all these things. So the communication is important for the tenant. And more important for the staff is because there's always worry of retrenchment, pay cut. So a frank and transparent communication to tell them the situation and what the company is doing will relieve them of their, the stress, so they know what's going on with the company and what's the plan, how are they going to handle this situation going forward. So I think with that, I'll pass on to the next speaker. Thank you.
Thank you, Andy. We'll call upon Dr. Chua now to maybe give his comments on the topic.
Overall, capital market has come off, and it's not just Asia Pac. Just to recap, it's Asia Pac, US, and Europe. They are all seeing decline in investment volume. GDP numbers are also being downgraded, although the actual recovery is yet to be seen. Some economists are expecting a Nike swoosh, as I say. Some are thinking that it might be a W or more of a long protracted recovery, a flat line, a kind of L shape. So we have yet to be seen. We'll just have to continue to watch the market, as Andy has mentioned. But at this point here, I just want to share with you some data points that I look at. If you look at some of the indicators I've been looking at, it's all red right now, right? Literally, it's all indicators, all leading indicators, GDP, FDI, unemployment, across some of the key core markets in Asia Pac that we track are in the reds. Although there are some pockets of green shoots that is rising, the PMI particularly, I'm seeing some rebound right now, both Australia and in China. They're a little bit more optimistic than we expected. But nonetheless, everything is still in the reds. Consumer confidence are quite weak. What I thought was interesting to bring to your attention is actually the real estate investment index that we kind of tracked. Just pulling out what I saw in RCA and benchmarking it against past 4 years. I used 2016 to 2019 averages on a monthly basis and see where we are. This is just to give me a pulse. It's not to be, it should be taken with a pinch of salt because real estate transactions are very lumpy, we all know. But to give you a sense of the mood in this market. I think so far what is interesting to me is the Australian market and South Korea market are seeing a little bit more activity on a month-to-month basis compared to some other markets. And I think this is got to do with where these markets has been traditionally. Interesting, Singapore as well. We're seeing a little bit of a could this be a dead cat jump? We are seeing, nonetheless, the volume in June has surpassed historical average in the last four years by about 19%. But this has to be read with a pinch of salt. Would be my point. I think key thing is we are hearing a lot now as well that as the banking sector continues to tighten, the global debt levels are now rising. If you follow the numbers reported by the International Financial Institute, International Finance, the global debt has actually risen by a fair bit, over 10 trillion in 2019, bringing it to about 222% of global GDP. This is a major risk factor because back in the 2007 or 2008 during the global financial crisis, that level was, this is 40% higher than what we saw at that time. This is something that we may have to keep watch closely, as we know that there are lots of private corporates, corporate debt is now rising, 92% of GDP today. In the down market like now, as tide recedes, we do find trash as well as treasure, and it's probably the best time to look at where deals are, where transactions are, and also as individual, I think it's the best time to reinvent ourselves, as some of the questions that the professors here have laid out in the next few be talking about. I think it's interesting to look at the skill sets that are emerging in the real estate world and how do we position ourselves. With that, I'll hand it back to our moderator. Kapo, back to you.
Thank you, Dr. Chua. Terence, you have the floor now.
Well, probably I will start off by saying that by explaining who we are, Colliers, and what do we do in capital markets, because I know that a lot of the audience here are students or graduating students. So just to illustrate what we do, and then before I go into the impact of the pandemic on the markets and on some of the international markets. Yes, okay, so Colliers is a global company. We are present in 68 countries. We have about 438 offices. These numbers keep changing. We're listed in both NASDAQ and Toronto Stock Exchange. And we deal with transactions of over 128 billion on an annual basis. So in Asia Pacific, we have about 94 offices across 16 countries. We employ 4,500 over people. They're all still currently being employed. We have transactions of dealing with about 27 over billion across the whole region. Now, here I would like to share more about what is capital markets investment services all about. What do we do? What do my team do on a daily basis? This is a skill set and industry that is a growing industry. What we do is that we keep very close track of the market. We understand market trends. We find out what's happening in each of the market. And with that analysis, understanding of market, we work with our institutional clients. They could be high net worth individuals. They could be developers. They could be institutions. They could also be family offices. So we work closely with them and share with them our knowledge of the market. And especially local knowledge. Real estate is still a local knowledge business. So our teams locally will filter out the information. We will share with our regional investors. And with that information, we work with our clients and understand their current portfolio. And looking at their current portfolio, understand where they are in terms of positioning, whether are they aligned with the market trends or they should be changing their portfolio, what sort of assets in the portfolio has to be rehashed. Particularly during this pandemic, a lot of them are re-looking at their portfolio and what they should be doing. I think we heard earlier from Andy about asset management. Not only asset management, but also asset repositioning that we have to work closely with our clients to look at. And then with that information about the market and the client, we move on to develop acquisition and deposition strategies how to grow their portfolio, how to ensure that their portfolio can come out of this crisis in a very nice manner. So the last part, the top left-hand corner is the last part, is where the implementation and the execution of the strategies. So we spend 3/4 of this circle as to developing, understanding strategies and developing it. But the last quarter is the most critical part, which is the execution and the implementation of the strategies. And this is the most rewarding part because it proves whether or not your analysis, your trend, understanding your strategies are correct. So my team, we have about 130 over of us across Asia. So we do nothing but to understand how we can advise our clients appropriately in terms of investment strategies and advisory. Now, let me move on to how the current pandemic has affected the real estate markets. So we heard from Dr. Chua, Andy as well. This is an unprecedented crisis. This is no ordinary crisis. It starts with a health crisis and is leading to economic crisis. So in terms of economic crisis, for the first time in the world, we are seeing every economy is looking at a substantial drop in growth, and many countries are going into recessions they've never seen before. In this chart, in Asia Pac, except for China, everyone is hitting to -5. In Asia Pac, we see as high as -10% recessionary growth in a lot of these markets. And the good thing is, the positive side of things is that we will be seeing recovery. And anything that come down, we have to go up. Okay, so we all patiently waiting for the upwards movement. So this year we are seeing the IMF, the World Bank is looking at about positive 2 to 3% growth across globally, but how much this recovery will take place is actually dependent on the last crisis, which is the financial crisis. To me, it hasn't come yet. It's going to come. So we have the health crisis, economic crisis, and we will be seeing the financial crisis. How fast the recovery will happen next year will depend on how grave this financial crisis will be. So over the last few months, this is how the different sectors have been affected in the various key markets. So right at the top row, you see the most affected. I think we heard from Andy, hospitality and retail suffer the most, because these two sectors are the sectors that depend a lot on cross-border businesses, cross-border investments, from tourism, from business travels. So hospitality across the region was seeing a booming trend over the last 2 years. So there were a lot of new investment made into the sector. And for the first time this year, this sector is, a lot of the hotels are seeing no revenues. It never happened to any real estate before. So this is very unprecedented. Retail, the same. Tourism, it was already hit by e-commerce before this COVID-19, and a lot of the retailers were trying to reformat their malls, reformat their business in terms of doing online, offline, integrating online, offline formatting for their retail business. But I think this COVID is pushing them very much to the offline, online business, and putting a lot less emphasis on the offline business. And so this is changing the way retail scene is going to be. The least affected, right at the bottom, is the industrial and logistic. To a certain extent, the suburban residential. In fact, from working at home or spending more time at home, right? So residential is still, it's an emotional asset, is not going to be affected by economic cycle. So for Australia, interesting, the office parts, biomedical part are the most resilient sector in Australia at this point in time. So this table actually summarizes how the different sectors are being affected. Okay, so we talk about how economies are being affected. We talk about how sectors are being affected. Now I'll go into the market specific. So China, on the top left-hand corner, we see China. China is the first country being hit by COVID, and also probably the first market to come out of this economic crisis. And we are seeing the government is doing a lot to pump prime the economy, and they are encouraging consumption spending. They are giving away vouchers. William probably can talk more about this later on, but we are seeing the Chinese government giving away vouchers to the citizens to encourage spending, cutting tax, cutting a lot of the other expenditure, taxation related things to encourage consumption. So we are very bullish with logistic, data center, business part in this market, because it is a very tech savvy population with this working from home experience, and with this business contingency planning that imposed on businesses, which they have never had to do that, is sort of driving a lot of the growth in these two sectors. And for Singapore, investors love Singapore simply because it is a very politically stable country. It's one of the most stable in terms of political stability in the region and in the world, actually. Because this is important, because we're a very small island. We have no resources. The only thing we have is our workforce and how we govern the economy. So this has been scoring very high. before the COVID-19, there was a study by URI PwC on investor sentiment. Singapore actually came in top of the list, so we continue to see their interest in the property market in Singapore, particularly for offices. Now, hotels, Singapore is a very important hub in the region. So we will continue to see, because of location of Singapore, we will continue to see tourism to come back in a big way. We continue to see businesses relocating their regional headquarters here in Singapore. So we are still very bullish with office and hospitality in Singapore. Probably hospitality for the longer term. Japan, we've seen, it was in recession for the longest time. It came out of recession over the last few years. Unfortunately, with COVID, it brings it back to recession. But the market is very resilient during the last few years' growth. For the office market, it has the lowest vacancy in the whole region. So we are very bullish with office. Logistics, because it's a very conservative society, a lot of the logistics facilities are very old-fashioned. So the modern logistic facilities, they're only 5%. I think with this COVID, is pushing this sector to develop more modern facilities. So we are very big on that sector as well for Japan. Hong Kong, very interesting real estate market. Is the most responsive, most volatile market. This is the first market in the region during this crisis where we see sellers coming to tell sales agents and say, look, I'm prepared to sell my property at 30% discount. Find me a buyer, but they need to all pay cash. So no other sellers in the region is prepared to respond to the crisis in this manner. So it is one market where we are seeing a lot of big offer happening, but unfortunately, I think the big offer gap is still quite far. But I think this is one market will recover very quickly in terms of price adjustment with a deep price adjustment. The rest of the market, I think a lot of the property owners are still holding on where they are and they're not willing to move their valuation. Australia is a very mature market. You don't need transactions to tell the valuers what to do. The valuers already adjusting the value in the market in the way they think it should be. So we are seeing some of the valuation being adjusted downwards, and some of the superannuation fund, we are seeing redemption on the funds. So it is a market we're going to see more values being adjusted. We like biomedical business part, which I mentioned earlier, as well as logistics. So investors should play the safe way to look at this market. So this slide sort of summarize how we see the different markets and what investors should be looking at. I will end my 10 minutes with, or more than 10 minutes with the last slide, which is the new normal. This industrial sector, as what you heard, is the sector that benefited the most from this COVID-19. And the key word out of this 6 months, what we learned is technology, technology, technology. So digital transformation of real estate is happening in a big way, huge way, leap and bounds. Everyone who owns real estate today has to understand how do they improve the productivity of their real estate by technology. So for the industrial sector, I will just focus on industrial sector in this slide. Is that so we heard Andy talk about hub and spoke. Yes, this is exactly what's happening. I think the e-commerce players, the logistic players, the warehousing guys are now looking at hub and spoke format for their businesses. They need to be able to perform the last mile delivery more efficiently because the demand is so huge that if you can't do that, you will jam the whole supply chain. So hub and spoke is something that is happening in a huge way. In the past, we consolidate all the requirement into one huge warehouse. Right now, you make sure that warehouse is in a very well located transport hub. And then after that, you have the spoke, where all the sub-hubs to be able to do the last mile delivery to your consumer in a very efficient way. And then the second point, flexibility. Given the supply chain, what we see, the impact on the supply chain over the last few months, warehousing, logistic guys start to understand how important it is that they have to be able to be flexible, to be able to provide additional capacity when the demand is there, and to shrink when they are not there. And then the third point is technology again. The real estate asset itself must be able to accommodate infrastructure, the technology infrastructure, whether it's robotics, whether it's AR, AI, the structure has to make provision to take on all this. Then configuration as well, how you space out, how do you adjust it, you need to consider all this. Also, lastly, of course, sustainability, green is also becoming a very important topic among the investors. Now, thank you very much. This is my last slide. Thank you.
Thank you, Terence. That was a very comprehensive overview of how you see the markets and the various sectors being affected. I think now we will have our last speaker, William. Over to you.
Sure, thank you.
Our China veteran.
Wow. Yes, maybe I have an honor to be one of them. I've been there for 26 years, and I was sharing with the rest earlier. This is perhaps the longest stay I have in Singapore over the last 26 years. I've been here for the last 6 months, and hopefully I can be back to action in a month's time or so. Having said that, I think I've gone through, it's a very exciting period I have over the last 26 years, and perhaps this is the last 6 months has been the most memorable one. As we shared, the earlier speakers have shared, we never see this before. I've gone through various different crises, whether it's 96 financial crisis, 08 crisis, I was in Beijing on the 03 SARS, and managed to only evacuate at the last batch under, at that point in time. And I would say that COVID-19 has actually set a new direction and everything for us, as the earlier speakers has mentioned. It actually drives us to rethink what is ahead of us. Specifically because my experience are more in China, I would say that it's lucky and unlucky in the sense is that China is the first one to lock down, and spend about 3 months, slightly off 3 months before it get back to full operations. We were lucky because at that point in time it's actually Chinese New Year, so the disruption were minimum. I would say as of now, China, as earlier Terence has mentioned, China will probably be the first one to recover based on the estimate. Of course, we are estimating between 2 to 4. Hopefully, we can hit something in the range of 3. And I think that would be good for everyone. As you can see, most of us are expecting Asia Pacific to have a negative growth for the rest of the year. And we are seeing activities and both economy and social activities back to probably about 80% of post-COVID as of last month or so. It's very encouraging. But again, China being one of the second largest economy does has a great impact on the Asia Pacific, as we see it. And we are very cautious about their recovery because, as you can see, China government is taking a very different approach from the rest of the world. I was supposed to go back last month, early this month. But then suddenly they just locked down again for 2 weeks because of 3 cases. They start to lock down. So China is taking very drastic action. And we expect this will be a new norm again, okay? In a way that China will take whatever they can to, allow the economy to come to a pause. But what does it mean to us, where CapitaLand has a huge investment and interest in China? We see it as what Andy rightly said, and I would say that all our panelists will agree, it's an opportunity for us now to take stock review all our operation processes and see where are the niche, the market that we can actually go in. In fact, if you follow the news and all this policy, China has been adopting also a slightly different policy compared to other countries. And maybe to most of the country are still trying to handling how to help the citizens in recovering or overcome this impact of the COVID. But China now has gone into phase 2 of the pandemic, which is how they can actually restart the engine of the economy. Last month, they have already announced a new 5-year plan, which is something very new to every one of us. We just more or less get to a grasp of what exactly do they mean by new infrastructure, which is earlier Terence, Dr. Chua, and also Andy has mentioned, is digitals. We are going to a new form of infrastructures as far as China is concerned. And they are preparing to plan to inject over 50 trillion RMB, which is equivalent to about 7 trillion US dollar or 10 trillion Sing dollar. That's a huge amount of money to be into the system over the next 5 years. And for this year, it will be 7 trillion RMB for the next 6 months. And we expect this to actually stimulate and help the market, to boost up and slowly to recover some lost ground over the first 4 months. And this is also one of the economic strategy which we believe that the Chinese is taking with the geopolitics and US-China tension. China now is trying to stimulate its local economy, which is big enough because as of now, as of last year, China has already switched its economic structures to 2/3 for domestic, which take out their GDP. The domestic market actually about 2/3 of their GDP, which is big enough and substantial enough. And with this new additional cash into the system, we believe that it will continue to, sustain the economy for the next 2 to 3 years. Of course, barring any unforeseen regional war or any, which we don't believe that we don't foresee any political instability, but perhaps some minor confrontation and increasing tension between US, China, and then Europe and China, perhaps. So these are something that we are watching very closely. On the domestic front, I think as what Andy and Dr. Chua, in fact, Terence has mentioned also, is that we are now also actively looking at assets that we think it will be a good time to buy. And this will be a time for good bargaining. Of course, we expect things to be not so easy bargaining because Chinese economy now, when they start to go back to actions, we are seeing a lot of interest in terms of market new investment and asset transaction as well, both on residential and commercial as well. And this is generally what happened to the Chinese economy and the market. And for Keppel as a group, our investment in China is not limited to real estate, which I'm covering. We are also involved heavily in infrastructures and also our fund, which we believe there will be this should actually help partly as a Singapore company in helping our economy grow as well. On Asia Pacific, I believe China will continue to play a key role, and that's why everyone is watching very closely their policy movement changes. On the other hand, is that while things looks quite rosy, unemployment rate has shot up. Unofficial numbers has already hit about 80 million, which we believe there will be more. And we are seeing a transition period. In fact, it has been started a couple of years ago in terms of restructuring the economy. And we believe that the Chinese is taking this opportunity as well to restructure their economy. And that's the reason why they have rolled out this new infrastructure plan, which mainly cover a few areas. Data center is one of them, 5G, full rollout of 5G for the entire China. This data center, biomedicals will be another area that we believe will be growing. And AI, as well. This will be actually in their national economic strategy. We believe Singapore should actually, as a Singapore enterprise, or even the Singapore government is actually watching very closely and see what are the areas that both countries can actually collaborate. The takeaway is what is ahead of us is we are very mindful of the volatile market, despite the fact that China is recovering, and cash will remain the first. The cash flow is the key to all survival of any businesses. So we are managing our cash very carefully. I think it's applied to all businesses. And super capital, or we call it super influx of capital, is something that we need to watch out very closely as well, and see how it will impact our both capital market as well as the industry, the real estate in particular, because we believe the money will actually flow into real estate, especially for China per se. And continue to look out for new things. E-commerce, digitization, and smart development, and will be the next theme for, we believe, will be the next five years or so. It's something that earlier Terence had mentioned rightly. As a developers, as a businessman, as an organization who, whether it's Singapore or China or elsewhere in the Pacific area, we really have to look into digitizations. COVID-19 has told us that if you are late, then it could be the end of your business. So we are quite lucky for Capitaland. We started our digitization or transformation about three to 4 years ago. In fact, the impact to our operation were very minimum, because as I shared, our sales, our operation were not impacted. Honestly, residential sales continue. Okay, we have visual sales office, online registration, booking, etc., and everything is gone through electronic. And what Andy has shared also is that get prepared. Being as a business, we need to really gear ourselves up in terms of smart and digitization, centralized of all the information, etc., so that you will be prepared for any unforeseen in the next wave or so. For our other audience who are graduating, a word for you guys is that please embrace digitals and smart, because this is something that you need to be mindful and equipped when you step up of the university into the market. Thanks, Paul.
Thank you, William, for your words of wisdom as from a China veteran. I want to open the floor up to Q&A. So there is a question on, this is directed to all the speakers. Aside from the pandemic, how have political uncertainties around the world, such as in the US, China, UK, EU, affected the volume and flow of real estate investments? Maybe Terence, I don't know, maybe you'd like to just take this first?
Yeah, sure. Now, the political situation in a market will definitely has an impact on real estate investment, because if the country is not going to be, the market or the country is not going to be properly run, you will have chaos. That is not good for user. So in terms of investment return, it will be affected. That in terms of investing in any countries or market, whether it's real estate or any other thing, you must have some form of a governance, law and order in the country, so that you make sure that your investment is being protected, particularly for real estate, because it's brick and mortar, and it affects activities that surround the real estate. So it's even more important to have some form of political stability in that country. The short-term political turbulence will definitely not, will come and go in every country, every markets. I work in more than 15 countries, and every country will have some political turbulence. There's some country where, you change government every year. The civil service is so strong that it really doesn't matter who is in power. For example, Japan. Japan has seen so many prime ministers, right? It really doesn't matter. So the summary of it is that it is a very important factor affecting real estate.
Thanks, Terence. Andy, have any comments on that?
Similar to what Terence mentioned, I think the uncertainty in political uncertainty in many countries is prevalent. I mean, it's continuing in many countries. So, if you are an investment company, that need to invest, you continue to look at opportunities. For example, if you think there's a problem with it, is there an opportunity instead? You give a contrarian play. So a lot depends on the individual situation of the country. But of course, if it's a risk of or very heightened risk of war, I think it's a very different story where real estate is something that's there, you can lose it. But otherwise, if it's change of political parties, there's some trade wars, typically what we'll do is try to price it into the underwriting. Basically, risk premium just increase a bit. So a lot depend on the situation exactly.
Okay, thank you. Here's another question. How has the crisis affected the valuation of real estate in your portfolio? Is it a clear-cut downward adjustment of valuation? Dr. Chua?
Not a very clear-cut kind of strategy that you take cut across the board. It all depends very much on the individual market as well. I think, and a lot of times you look at the asset in terms of its income. I think so far I'm observing not too much of our own asset portfolio, but I just look at generally and what people are doing in the market is that you find the Australian market is a lot more transparent. Asset valuation cuts seems quite severe. I think you heard a lot about the pension funds taking a 3 to 7% cut in valuation across the board. In some cases, you find that other players tend to hold the cap rates stable. So as income starts to drop, capital values will drop accordingly just to keep the cap rate stable. So it's not a hard and fast rule. It all depends on where the asset is and the market conditions. And I just want to add to the earlier contribute to the earlier discussion of the definitely political stability is one of the major factors when it comes to investment criteria. But if you look at the political situation, many a times what it will affect is actually the cross-border transaction a lot more than, say, your domestic investors. Here, a case in point, I was just looking at the Hong Kong transactions in the last couple of quarters. And despite all that rigmarole that we hear about, yes, definitely the cross-border transactions have weakened. You're not seeing any foreign investments in the market in the last 2 quarters. Instead, you have seen actually foreign, in terms of Chinese investors, are more active. So the point is, if you are investing in those markets, the domestic players tend to be a lot more confident because they are in the playing field. What political instability usually affects, first card will be cross-border transaction.
Thank you. Here's a question for William. Do you think China assets are undervalued? And since you predicted a large cash flow injection into the real estate market there.
Well, this is a very good question because I would say China market, yes, to some extent is undervalued. If you were to compare based on the first tier city, I would say China as a whole, the market is huge. So we usually compare tier 1, cities like Shanghai, Beijing, or Shenzhen, relative to Hong Kong, New York, Singapore. If you measure by that measurement, certainly in our view is that it's undervalued. And given the huge liquidity in the market, what we call super liquidity market, and the special characteristic of the China market where it's not unlike Singapore or Hong Kong, free flow of capital. Certainly the huge liquidity is going to push up prices and the value of the assets. That is something that we are watching very closely. Of course, the danger is that when will the bubble burst in China? This is something that we are all watching very closely. We expect, I personally have expected it a couple of times, but realized that whatever economy theory that we have learned doesn't seem to apply in this so-called communist capital structures, economic system. Having said that, we are seeing actually a compressing yield over the last 1-2 years, and we're watching closely now that with this huge liquidity in the market. Okay, I think the yield, as far as we are looking at now, probably still remain quite. We will see that the value of the asset was still on upward trend.
William, I want to just take off from the point that you mentioned with the yield compression. There are 1 or 2 questions here from the audience on this and a related point about debt. I think Dr. Chua mentioned about very high debt levels that were exceeding the previous crisis. And you also highlighted that in a market like China, and I think I also heard maybe a few other markets have the same experience, that the yields have compressed so much, and it's helped by the fact that there's a lot of injection of liquidity into these markets by central banks and governments all over the world. So when will the music stop? Do you think the music will stop, or that is the $1 million question?
If you ask me, it's going to be $1 billion question, but really we hope that it will also slow down, but not to the music stop, because you'll be disaster. Not sure about the rest of you. Especially for market like China, it's, you see, in that kind of structure, Chinese economy is good and bad because it's quite enclosed to a large extent. Even though we say that China is trying to open up, but you can see that capital flow is not easy. It's allowed in, and when you start to flow outflow, is well controlled by the government, and they are trying to keep it within the system itself to spin off the economy. So we believe China will still have, at least if everything, constant, everything normal, if we don't go to a war, given the scale of the economy, the size of the economy, and the plan that they have, I believe the whole system will continue for at least another 3 to 5 years at least. Unlike a country that outside China, ex-China, that probably will be experiencing a more urgent call in terms of how to control the bubble.
Dr. Chua, you have any comments on that? I mean, you mentioned the situation you described earlier of rising debt, right? I think we also know that because of the injection of liquidity, rates are low, and they're going to be low for probably quite a long time. So is that a risk that the kind of environment is going to lead to even more yield compression, which will also lead to bigger and bigger bubbles? So, is that a risk that you would flag to your investors?
I think without bursting anybody's bubbles are clearer in retrospect, right? So there are 2 theories to it. So at this moment, we're in a bubble, you can't see the bubble. I like to think, like William said, I don't wish for the bubble to burst. Maybe a controlled deflation of the bubble. Yeah, clearly with the kind of liquidity debts it's happening. I'm optimist. I think that perhaps because of the tightening of liquidity, money being funded away to other parts of the economy, private debt is increasing to support real estate. That's fine as long as it's done with due diligence. But I think that's the risk. The uncertainty about the security, how these debts are being exercised and given control of it. That is where most economists and researchers are concerned about. But are they stringent in the way they provide the debt? I think that is one risk factor. But in any regards, I think in any situation, real estate has always been used as like a second lever to the economy. The larger economy growth and consumption, investments, real estate being a derived demand is often used as a second primer to help shore some of the investments. And I think with lower costs, naturally some of the money will be put in there, and there's tendency for further question of use. If it's beyond right now, we're beyond structural level, and that's where my concern is. But if everything else is so low, perhaps contained is probably all right. I think my long-term view would be how do we unwind going forward? Should this where will be the new normalcy? You know, is this a 0.5 or 3% office yield? Is that the new normal? Everything else is at a low deflated kind of inflated kind of level. Then perhaps okay. So that's my convoluted view of where the debt situation and how it might impact. Terence maybe have a better view of the capital market.
Yeah, no, I think I'm on the same page as you in terms of I think I'm also positive optimist in that over the last few years, in fact, we did see yield being compressed, but we did not see LTV going unreasonably high. A lot of the financial institutions I'm talking about Asia Pacific, is that the banks have learned their lesson during the GFC. So for real estate, even for China, for Australia, Japan, they're all very careful with real estate. When the yields start to compress, some of the banks take a very conservative approach to lower the LTV. So I don't see leverage debt is as a problem in real estate in Asia Pac. It may be in some other part of the world, but not so much in Asia Pac as of now. In fact, with the low borrowing rate over the last few years and going forward, I think having that is more of a corporate issue rather than a real estate issue, if anything. One thing I want to also add is that the risk premium given to yields. So over the last few years, we see all the yields being compressed. All the sectors we see, anything you look at, the cap rate is about 3 to 4%, regardless of actually where they are. Unless in places like Australia where the borrowing rate is higher and China borrowing rate is higher. But where else when the borrowing rate is about 1 to 2%, all the cap rates is about 3 to 4%, whether it's Japan, Singapore, Hong Kong, it's sort of an equilibrium across all sectors. But with this COVID, it changed everything, it reset everything. So sector, right now, the risk premium that's given for each asset classes is now very different. Hospitality, you will want a risk premium of like 500 basis points in a market like Thailand. So in the past, your risk premium is almost like 100 basis points. So people now need to distinguish the risk from the different asset class a lot clearer, a lot more than before. In the past, because of weight of capital, everybody just buy real estate regardless, ignore the risk premium almost down to zero. But right now, because of this, everyone start to realize that the risk premium for different asset class is different. So the core asset like prime, trophy, class A, building, and a business park asset and a logistic asset, right now in this environment is being affected very differently. So the risk behave also differently. So I think that we'll also have to look at that risk premium that you put. So I think that for real estate is not a big deal. Thank you.
Hey, thank you, Terence. I think it's a very balanced and informed view. Got another question here. If the COVID-19 vaccine does not yield positive results over the coming months or next year or so, what's your take on the market? Will global companies, REITs, drastically reduce their portfolio size if this continues? Will there be rising distress in the property sector?
I think a lot depends on whether there is what I would call a second wave or third waves, that will impact lockdowns, border controls, and those are the measures that actually have a very big impact on real estate. Like we saw in the hotels, retails, and on the other side, things that actually benefit from it, where they are digital or e-commerce linkage, like logistics. Those are actually do better. So a lot depends on whether we have this more wave, or alternatively, it could be just, if you just, people get used to it and the effect is not as you without the vaccine, but as you know, the symptom, not everybody have symptoms, and if the issue is not so a big problem, then probably less of issue. But if there is the second wave and third wave, certainly I think impact on property prices, and then once that impact when you look out for new investment, you'll consider that, and probably you'll reduce your investment during that period as well.
To add on what Andy just said, that is regardless of whether, okay, if you do not have the vaccine, there's more urgency, there's more reason that you have to do more active asset management. You really have to look at the portfolio and actively manage your assets, and also rebalance your asset to make sure that if this thing is to continue, whether it's a second wave, third wave, you are prepared for the worst performance of your portfolio. So you want to rebalance, meaning that you may want to cut loss and sell one or two assets that will be badly affected, or you can't turn around, and then you start looking at assets that will be able to ride through this crisis, like logistic or prime, or buying an office building with or a business park with grade A, high credential, single tenant, blue chip tenant that give you a 15 years will, where your income will be 7% unaffected over the next 10, 15 years. So you can balance your portfolio on that. So in good times, we take things for granted. You don't do anything, the real estate will make value for you, will give you the returns that you need. But in times like this, there's a lot more work, a lot more active asset management, portfolio management, to make sure that, if things not going to get better, it's going to get worse, you are at least protected, and your portfolio can withstand that kind of shock. It's like managing your own stock portfolio, right? So what to sell, what to buy, what need more active management. Thanks.
Yeah, maybe the term used is probably defensive portfolio. I think you probably, if in time of the uncertainty that without vaccine continuously, you want to be more defensive, I guess.
Okay, thank you. Here's a question for William. You mentioned about the importance of digitization in real estate operations. What are some of the prop tech solutions that CapitaLand China has adopted? So we're trying to get your company secrets a bit.
I would say that few things that we have done, and personally, I also involved in driving them. I think what we in terms of prop tech, okay, sorry. Key thing is that you got to review the production. In fact, now we are looking at, we have been looking at it, and in fact, CapitaLand was chosen as the demonstration. We were one of the projects that demonstrate, showcase various features or smart features in Tianjin Eco City, because as you know, I was one who involved from day one, 2007 until today, Eco City, and we just launched jointly with the Chinese government, Tianjin government, and this is the first time that G to B, the government and business are working together on coming up with guidelines on how, what will be the smart cities guideline. When we talk about technology and digitization, it actually entails the entire process and not only a special certain technology or gadget or whatever. Is that we actually took digitals into all our decision making and as well as business. I think that is very important moving forward for any businesses and organization now. We no longer look at real estate as a pure cement and mortar. It's how this real estate actually can be interactive and actually can be responsive, you know, to the residents and to the consumer and to the customer. And actually, we are actually looking at the entire ecosystem now. We are also working with, if you are talking about digital technology, it's very common. I think camera, AI, these are given to us in all our new development. It's a must now. In fact, in China, to be competitive and to be ahead of the system. And minimally, you got to at least provide the certain standards, minimum requirement for real estate, whether it's been in the office or commercial or industrial. And that actually, you see, digitization is one of the facade that we're using. And at the back of it is, we are using this to collect the various data information. And through this, we have to analyze all these data, information, and extract value from it. We believe that data will be, data actually, all of us will agree that moving forward, data is oil. It's where we will extract benefit from it, and value can be created through a proper and systematic way of analyzing and extracting data. So when we talk about digitization, it's not only looking at the gadgets, you know, until first customer experience, we satisfy their wants and needs. And from corporate itself, we will have to extract, find ways to extract value from all these data. And also working with the government is also looking, authorities are also looking at how this data can help them in better planning in terms of their policies and their, in terms of their city management. So as far as Keppel is concerned, we are looking at digitization as a business and total, not only in the real estate, but in more of a management of a city, a precinct, of the aspects. And also at the same time, we are also looking at new business model riding on digital informations and the data that we can extract from it.
Thank you, William. Here's a question for Dr. Chua. How is COVID-19 recovery changing the way we view, plan, and manage global cities going forward? This is a very big question.
I don't want to spend too much time on this. This can spend the whole day talking about the future of planning. But by and large, for those who remember, the purpose of planning really started off as a hygiene issue back in industrialization era. Had really polluted cities, very dire conditions. So the whole movement about planning and making sure that overall quality of life is maintained and ensured for the residents. And then you had a whole movement of garden city concept, people moving out of the inner city, because primarily again because we want a better quality, better hygiene for the family and children. And I don't think this has changed. COVID-19 has in fact, in a way, reminded us again that as urban planners, as planners and developers as well, we do have a fiduciary duty, in my view, to make sure that the space we offer to them, we offer to the citizens and the resident users, has to be future-proof and has to be of a certain hygiene. I think the COVID brings that whole issue back to our front again and say, oh, what are we doing? Have we forgotten our fundamental purpose? Have we been optimizing too much, perhaps? Do we need to now relook what are the right measurement benchmarks? So global cities or not, global cities, literally, the definition, global cities are cities that are well connected to other cities as well. I think it doesn't matter what cities you are in, what hierarchy you are in. All it ends on the day is to make sure that users and users have a decent quality of life and hygiene there. How COVID is going to change it? It's just going to bring us to reflect again. I've seen a lot of research done right now to relook at, not just on ESG, some of you have seen it, really looking at the local resources, right? Japan has started again, timber as a new way, not a new way, but an old way rehash. Australia has also adopted new high-rise buildings using timber construction. again, it's all re-looking at how can we better the environment without being so overly dependent on other economies. A bit of regionalism that's rising. This is just a short but a very big question, but happy to take it further with you one-on-one.
For the speakers, I just want to maybe make this last appeal, whether you have any final thoughts. Now, there are a couple of questions from the students, because this is organized by NUS largely for student community. Your last comment for them, that there's concern obviously for the fact that many of them will be graduating in a very different environment compared to what they were, let's say, 2-3 years ago, right? And Andy at the beginning said, never waste a crisis. So tell us, for each of the speakers, what is your advice to them, your last few words to them, your words of wisdom to them, what they should do, how do they manage this situation that they are in?
I think I'll try to answer one more question here, because I think since there's a lot of students here, this is on, for graduating RE student, are RE companies still actively hiring fresh grad? If so, what aspect of RE has the strongest demand? RE finance, sales, research, asset management, etc. Okay, so there's good news and bad news, okay? Bad news is that, yeah, I think most companies are freezing their hiring freeze, because I think market is tough. A lot of properties incomes are coming down. So as far as I know, many companies are either freezing or letting go of people. Good news is that the Singapore government has helped a lot. I mean, they have this training scheme where you come in as an intern in training for 9 to 12 months. They pay 80% of your salary. So a company like mine is actually willing to take new fresh grad with that scheme. So that's the good news. Okay, on the aspect of RE's strongest demand, I would say that depend if it's an investment company and cash-rich company, I think this is a time for them to look at acquisition opportunities. But a lot of companies, as I say, if they are difficult time, they are consolidating. Asset management is where they are paying a lot of attention on how to be more efficient, effective, how the asset enhancement, to make sure that they are defensive their portfolio so that they can live through this period. Okay, and my last word is wisdom is never waste a crisis. Take the opportunity, learn as much as you can, whether it's internship or whatever, learn as much as you can. Thank you.
Last words will be flexible and humble. I think in this current era, flexible as in just be prepared to take what comes, and so with humility in there, you don't put yourself up as this and that, and I only do this and that, but be prepared to do the dirty jobs at times. Be flexible so that in the event you may not be able to find a suitable job, there is that whole training, enhancing your skill sets, and especially in the digital space. For those who are not yet in the digital space, I urge you to take this time to enhance your skills, develop it further. It is very crucial.
I do share the same views as what Andy Hammond said, but just to add on that, I think as the thing is that yes, the companies have stopped hiring, but the companies may have to go through some replacement hiring, and during this bad time, they may be looking at not hiring too experienced a person because of cost saving. So as fresh graduate and you will be able to step up, will be given the chance to step up to filling some of these roles. So it's very much dependent on you, whether or not you can prove yourself that you can step up onto some of this role, like what Yang was saying, that don't pick and choose, and try to do do your best is what you are given. Anything that come down will go up. So while you wait for the market to recover, like what Andy was saying, learn as much as you can, take out additional courses, learn what is, okay, there's a lot of mismatch right now in terms of the employment market. The skill sets that the new employers, the new industry will want, they are still hiring, but unfortunately, that the market evolves so fast, the skill set is being evolved so fast, the demand for this sort of skill set evolves so fast that the education system couldn't produce or couldn't evolve or change as fast as it is. So as when you come out to the working world, you need to catch up, evolve with finding out what sort of new skill set you need to learn and adapt so that you can, deliver, you can meet the demand of the new job scope. I think this is important. So find out exactly what is happening, those stay, find out what is changing. Just now I shared technology and real estate is getting very integrated. So learning more about technology for real estate grad makes a lot of sense.
Three panelists, as I said, has already given a very good advice. I think I will share with I agree with the rest, is that at this critical time, don't be choosy. Take anything that is on the table for you. Take it as an opportunity to, experience it and learn. It's important that you learn and go through this stage. It's never easy. People like us are also in a critical, it's also being threatened, to be honest. Like what Terence said, people may be looking at a cheaper alternative, to replace us. So it's a philosophy, whether people like us or you guys graduating, it's a continual process that we constantly learning new skill sets. I think it's important, and Terence rightly pointed out and put it in the very right way. Digitals and real estate is something that we are looking at it, that is going to be the future for real estate, because it's no longer, as I shared, it's no longer like what we used to learn 20 years ago or even a couple of years ago, right? Talking about digital, but now digital age has gone so far and fast that we are even looking at 6G now. We are no longer looking at 5G alone. 5G is a must now. Okay, so we are preparing. What will be a new, for example, new marketing, new real estate sales, real estate design, even architect has to look into the new way of designing a building to incorporate all these new technology. So do pick up new skill sets, in particularly the technology part. It will be very important for you guys. People like us will also have to learn at 55. I'm still learning new technology, So I hope that you guys will continue to endure and push on. It's not going to be easy, but we believe that anything comes down, will go up again. Even if it's the L shape, eventually it will go up again. Okay, so good luck to you guys.
Thank you, William, and all the speakers for your very wise and encouraging words. So thank you once again.